Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about whether the Federal Reserve should care about home prices and make policy accordingly. It's a very timely topic, so let's dive in. Logan, welcome back to the podcast.
It is wonderful to be here. It's Thursday, so this is the day where Trump is going to, I think, meet with Powell at the renovation place. So that should be some popcorn material too. Again, Fed meeting is next week. We've got a lot of drama, but today's topic, there are some Wall Street players that are starting to say, well, home price growth is cooling down. There are people that need to refinance, and the Fed is keeping rates too high. If home prices start to fall, people will, pull back on spending because of the wealth effect. And I didn't agree with that at all. I said the Fed really should not care if home prices are falling on the existing home sale side, unless the economic data around it was getting weaker. I mean, deflation is rare in America post World War II. Nominal home prices falling is rare outside of World War II. But, the two times that we've had, the Case-Shiller index go negative, of course, 2008 was an anomaly event, but 1990, 0.7% decline, 1991, 0.2% decline. But I think that conversation, I'm willing to have, that the Fed should kind of ignore home prices falling if the economic data around it is still doing well.
Let's talk about that, because you have definitely called out the Fed and said, hey, they don't care about housing. And at different points, we've had a headline that says, will the Fed start caring about housing now? So what part of housing should the Fed be paying attention to, and why is this different?
So obviously they don't care about the existing home sales market because they say nothing, right? Existing home sales had the fastest home sale crash in history in 2022. I mean, literally the second half was just a waterfall dive. It has been here the calendar year, third calendar year of the lowest home sales ever recorded in history, and nothing, because how they look at it on the economic side, it's a transfer of commission industry, right? So wages are down, incomes are down, commission checks are down. On the overall side, they don't really put too much weight into the economic factor of it. But the new home sales sector, residential construction, the new home sales data came out today, 3 negative revisions, misestimates, but the completed units of sale for that sector has now prevented housing permits and starts from growing. So housing permits and starts growing is a variable there. But, to me, it's, if residential construction workers, especially now that private payrolls have slowed down, if they start losing jobs, then, that can push the jobless claims data, which jobless claims data came out today. Fine. Excellent. We're near back near 210,000 again. Continuing claims are elevated, shows you the labor market is getting softer. But for me, the Federal Reserve is, hey, listen, we're not going to budge until we see the labor market break and jobless claims are low. So the new home sales sector has a little bit more merit, because if they're cutting prices and their profit margins are falling down and they can't grow sales, those jobs will fall into the residential factor. And then there's specialty trade, that data line, that labor data line starting to roll over. That makes sense. But the existing home sales market, we have places in the U.S. where they're not anywhere close to the peak of where they were in 2022, and they're still functioning economies based on the Fed's dual mandate. So I'm taking the other side on this argument that, if home prices fell like 2.1% nationally, is that really going to, is the wealth effect where you have like $36 trillion of nested equity out there, is that going to really pull the strings? Or is policy too restrictive that consumption starts to go down and big ticket item purchases go down, or capital investment into, rates are too high for people to want to invest? We're not there. So I don't think the Fed should look at that, how some people are talking about it right now. They're really trying. There's a lot of people really pushing on the rate thing because Trump is doing it. It's funny. I see this. I'm not a political economic theory guy because I always say, what do we always talk about? I see really smart people get dumb very fast because they get into the political rise. And I see people who are like screaming that the Fed should have been raising rates and keeping rates high. And all of a sudden, no, the Fed should do massive aggressive rate cuts. And I just don't want to be that kind of jackass, that all of a sudden my guy is in power, that I'm going to turn my principles all the way around in economic theory because of that. And I just like shoot me if I become. I always tell people, if I ever turn to one of these, block me. Don't ever listen to me. Don't look at my Instagram. I've become what I've despised the most. But in this case, I would make a stand that as long as the economic data is firm and labor is holding up, the Fed probably doesn't care, or nor should they care. Deflationary aspects and the negative consequences of that, and if consumption starts to go down and jobs are risk, that's a whole different thing. But we're sitting here. It's almost August 2025. Home prices just hit an all-time high. Hopefully now people can understand why it's like really hard to have nominal home prices fall nationally, but also these big, mega, huge national price crash declines forecasted for many, many years just haven't happened, even with 3 years of the lowest sales ever recorded in history when you adjust it to the workforce.
I think you would just say you just don't want the Fed to be old and slow. Like they don't need to change their entire way they do things. They just need to not be old and slow.
My approach has always been the same since 2022. I have no problem with the let's mirror the Fed funds rate with 3, 6, 12-month core PCE. I have no problems with that. I was completely fine. They changed the ball game because of global pandemics, very inflationary, and then the disinflation happens. Now, we've already done a soft landing because the disinflation already occurred and the labor market is stayed intact. What's happening right now has nothing to do with the soft landing. That discussion ended last year. We don't sit here and keep on talking about a soft landing. That's over. The economic cycles don't work for the last 100 years because of a soft landing theory. The Fed funds rate mortgage rates don't need to be up here. It's not going to change anything if they just go down to 6, right? And that's what like I always said, we have an economy where private payrolls are slowing down, and we have just one sector with a black eye, a broken nose, and missing teeth. And we're just showing itself, and it's like they're like, because I know they're afraid, right? I mean, the whole concept of people buying homes, having sex. One of the reasons why the Russians hate us, the Iranians hate us, the Chinese hate us, the anti-central bank people hate us. People buying homes, having sex, getting 30-year fixed mortgages, fixed debt costs, rising wages. This is one of the huge advantages post-World War II in America, right? And they believe if you keep rates elevated, people are going to, like the only wet fantasy these guys had was 2008 because they thought it was lower rates to higher rates. No, it was a credit boom, credit bust, exotic loan debt structures. Here it's not the case. So in this case, you don't need to be that restrictive. You could get down to neutral faster. That's completely different than what Trump wants. Trump wants emergency rate cuts because interest payments are going down. The deficit data goes better. So there's a whole different concept around here. But we go back to the Trinity discussion with that Trump believes he can win this if he has lower energy prices, lower mortgage rates out there, and that those two together would offset any kind of increase in goods purchase, goods prices. When the tariffs start to come in, and they're always going to be on a higher tax rate, somebody has to pay the piper here. But they think as long as consumers consuming goods, who cares? They can win this argument before the midterms happen. So that's why they're really trying to push down rates. That's the Trinity: lower dollar, lower energy prices, and lower rates. 2 of the 3 have been had. Just the third one hasn't. And we're only talking like getting to 6. We're like 55 to 75 basis points away, and you can get this to work. It's just that's the frustrating part that they just That is just holding things at bay. And now it's just going to be a popcorn show with Trump and Powell and a lot of conservative types who are all of a sudden big rate cutters, man. Ooh, these are deep rate cuts that they want down to 1.5%, 1%, something to that nature, which is something they would not have backed in, a year ago or 2 years ago.
What would happen? I mean, I don't think there's any chance that Trump can get those kind of rate cuts, like 3%, things like that. I mean, there's just no way to do that right now, unless he gets someone in there besides Powell. But it don't you feel like everything else that would happen if that did happen, it would just destabilize other things, right? So it's like in the net, I don't think we get what we want if that happens.
There's two ways of thinking of this. Usually the Fed plays catch up with the bond market, not the Fed cuts rates massively and the bond market has to follow. I mean, with COVID, we all knew what was happening. This was a huge deflationary event. The 10-year yield, God, was it March 9th, 2020, was 0.32%. You remember that? That's where that day.
Crazy.
I remember that day because I tweeted out. I was like, "Oh boy, we're about to have a mortgage market meltdown." Like the whole system was not designed for like a 90% ratio EPO sector. It was a boom. You're just going to get that. So, um, we don't have cycles that work that way. You don't have like, let's fire the Fed, let's put somebody in there, let's fire all the regional Fed, and let's cut, 3% rates to below where inflation is. That's an extremely accommodative policy. It would be a lovely test case. I tell you this, the nerd in me would be like, what would the bond market do? Some people say that the 10-year yield would go up and mortgage rates would go up. Some people would say that eventually mortgage rates will go down to 4% or something like that. In that situation, you have to deal with the consequences of that. In any case, it would be a great test case study to fire not only probably the Federal Reserve, but regional Fed presidents. Turkey does stuff like this. Didn't end well for them. We're a much different country than what Turkey is. So it's just, there's one thing if you want to talk down the Federal Reserve and try to get neutral policy, but he's not talking about neutral policy. He's like saying we're going to save a lot of money in the deficits. And we brought this up like well before, like watch the deficit discussion because the net interest costs will go down. And then a lot of conservatives said, hey, listen, we go into a recession. We're doing this on purpose because we have to refinance our debt. They've made up a really good, they have like this summer camp of lies on the internet where all the groups working together. And then all of a sudden they stopped talking about it. Like that wasn't a thing. That's very amusing to me. But it would be a good test case if something like, I don't believe that's going to happen. I don't think Bessent would actually kind of allow Trump to go that wild into there. And of course, the mother marketplace corrects everyone. I mean, just the 10-year yield getting back up to 460 made the Fed, made Bessent and them come into the White House and go, hey, delay the tariffs out. This isn't working.
Okay, so talking about things that maybe can be controlled, or there's something that Trump and his administration can do. Have we seen any results from trade deals? Have we seen trade deals and any results there for mortgage rates?
To me, you're going to need a lot of trade deals to finally happen, get signed, and where the Federal Reserve can actually say, okay, these are the percentages. Now, obviously, Godzilla tariffs weren't going to work, right? That the markets just threw that up in a second, and the inflation expectations, especially like the Atlanta Fed has a inflation expectation from businesses. And when Godzilla tariffs were there, that thing just went, vertical. That has come down a lot. We're not back to pre-Godzilla tariffs, but we're heading that way. So when the Federal Reserve starts to say, okay, these things weren't as bad as Godzilla tariffs, but they're not as good. Okay, maybe we have a light at the end of the tunnel. Then they could start hawking a little bit more dovish, and the bond market and everybody would adjust to that, because where the 10-year yield is and where mortgage spreads are, it looks perfectly fine to me. Like 435 to 470 on the 10-year yield. As long as the labor market isn't breaking or economic data is getting terrible, that looks fine. So today, like this morning, jobless claims came out, was really good. Bond yields went up 3 or 4 basis points. Other economic data came out. Bond yields fell 3 or 4 basis points. So we're just hovering around here, which would make sense. But let's just say that all the trade deals are done. They're all signed. Then the Fed presidents go, okay, we have a little bit more clarity on where we're going. Then, you could just slowly move that Fed funds rate, guide the market down, and the bond market feels a little bit more comfortable. And we're talking about, the calendar year of 2025. We're not talking about long-term Fed funds pricing down to 27. Like the markets don't really care about, nor should anyone else. It's what's happening now. So more clarity is a positive, but clearly Godzilla tariffs, that wasn't working. So you get more deals signed, you get something with China, you get something with the EU, Mexico and Canada, our big trading partners, and then we could kind of move forward with that. So it is a positive because the Fed has the question marks, but it is a positive for me to see the Atlanta Fed inflation expectation data, which focuses on businesses, that things start to come back down because there'll be less pressure on them on that side. And again, all we are talking about, we're not talking about Trump wants, just getting down closer to neutral policy where you could get that 10-year yield easily down to 4%. And with mortgage spreads the way they are, it gets a little bit better. You don't need sub 4% even to get near 6% rates. And then, you could take it from there. But the data in the past, things work a little bit better in that front.
So you mentioned jobless claims today. And when you say they're good, you mean like, so if you're in housing, of course you don't want people to lose their jobs, but you do want rates to come down if they could. So when you say jobless claims were good for
Jobless
who?
claims are good.
What does
They're
that
good,
mean?
but they're not having the impact. Good jobless claims data isn't pushing the 10-year yield like up to 5% or anything like that anymore. We're in a much different mindset. So the continuing claims, which is a second version component of jobless claims, that still is elevated. Remember, labor market's getting soft. Again, all of us would be having a different conversation if government jobs actually lost jobs instead of. It's so funny to me that this month, where so much of this is still based off of that one jobs report where government really saved it. So in this context, jobless claims fine. You don't need the labor market to break to get the 10-year yield. Obviously, this has happened a few times now. But the markets, if you want to stay lower for longer, the Fed funds rate has to come down. And the market has to believe that we're getting toward neutral policy. Then you could get, near 6% rate. So again, I'm never going to be that person that says I'm rooting for jobless claims data to be bad.
I know.
So as soon as that report came out, I tweeted the chart out there and I was like, take that, doomers, American flag with the muscle, not yet, so and then hopefully by now, everyone's listening. Hopefully by now, whoever you were listening to for the last few years that were adamant about the impending recession, any day now, with this chart and that chart, and people take like Challenger charts and they show this, and no, there are certain data lines that traditionally have to break to certain levels before we can go there. And we've made that stance in 2022. We said jobless claims have to head up toward 323,000 on the 4-week moving average, not the headline, because the headlines, you have these seasonal spikes and moves up higher and moves up lower, these waves that look perfectly normal. And that we haven't had that labor market breaking. So residential construction workers, specialty trade construction, if you lose that sector, then that jobless claims data can shoot up. But the new home sales report today, for what it's worth, we've been in a sales range really since 2018. You take the COVID-19 bump up in sales and then the 2022 crash in sales out of the day, we're pretty much just stuck in a range out there. And again, the builders have a lot of homes that have not started and they're just like, okay, we just need 6, man. We could get things going. So they're holding on to that labor out there. And so far, there hasn't been any like mass reports of projects not being able to be done because of ICE or anything like that. So We'll take every report in. Again, housing starts, new home sales, very critical to economic cycle work. But as bad as the new home sales is, it hasn't started crashing below the 2022 levels. If that was the case, that's a whole different subject, but it still is kind of held onto this range for the last few years.
Okay, so next week, jobs week, right?
Fed week, jobs week.
Whew,
Oh my.
this
Oh
is gonna
my.
be crazy.
That is that's going to be true. You know, again, if government jobs were lost in the last report, I think we'd all have a different conversation. So we kind of want to see what happens. We want to keep an eye on private payroll data on that. Government jobs can't bail out the BLS report, every month.
I
So
wouldn't think so.
yeah, it is. You can't hire that many state people. Again, it's just that was such a hilarious report. But the Fed, of course, the Fed isn't cutting rates. You're going to get some. I'm sure Christopher Waller is going to descend and say he wants a rate cut. Maybe Bowman does the same thing. The Q&As are going to be, again, the whole thing, labor over inflation. Now, hopefully, now that the growth rate of inflation fell so much, but mortgage rates didn't, the labor market really runs the show. So, of course, all jobs week are going to be very key. But you can have low jobless claims and the growth rate of payroll slow down. The one thing, what we've talked about going into this year is labor force growth. With less immigration out there, the labor force growth isn't really picking up anymore. And again, it just means the unemployment rate can stay lower for a longer period of time if less people are looking for work. So that's something to keep an eye on for the rest of the year, and even for 2026. That you really need demand shocks and things to break to get that unemployment rate higher. But you can have this like slowdowns in payrolls and have it be an issue, but not have the unemployment rate take off as much as people think.
Logan, we are out of time. Thank you so much. There is so much going on, and who even knows? Because all that stuff with Trump and Powell is going to happen after this podcast. So good thing you're on tomorrow too. We're
Popcorn.
talking today. Get your
Yep.
popcorn ready.
Popcorn. Get it out. And the next 8-9 days, big time popcorn. I don't really eat popcorn. I don't know why I say that.
My gosh, I love popcorn. I eat it all the time.
Oh man, no. I don't eat fries either. So
you're just not.
No, it's I went and saw Superman the movie, and I was trying to get stuff to eat, and I was like, wow, I don't eat any of these things anymore. I'm not like a teenager. I used to have popcorn, Skittles, M&Ms, Cokes, and I'm like, I'll take a chicken sandwich.
They're like, what? For a movie?
Hey, when you get to be almost 50, things change. You can't eat like when you were a teenager.
Oh my gosh, you are coming up on a birthday.
I'll be 50 soon. The F50 chart daddy made it.
That is wild. Still a baby. Okay, we'll talk to you tomorrow. Thank you so much, Logan.